Another day, another story. Welcome back, fellow investors. Welcome to Investment Motivation. In our last video we have learned about ETFs from our video series Stock Market Basics. Today we are going to learn about dividend in this video. Today, we're diving into the world of dividends in the stock market. If you've ever wondered what they are and how they can sweeten your investment journey, you're in the right place. Let's get started. Defining dividends. Alright, first things first. What exactly are dividends? Think of dividends as a little treat that companies give to their shareholders. When you own shares in a company, you become a part owner, and guess what? As a thank you for believing in their success, some companies share a portion of their profits with you. That's dividends. Important dividend basics for beginners. There are different types of dividends, each offering shareholders different ways to benefit from their investments. Let's explore the main types with examples. Cash dividends. 1. Cash dividends are the most common type. 1. Companies distribute a certain amount of cash per share to their shareholders. 2. Example, imagine you own 500 shares of XYZ Corporation. 2. If they declare a cash dividend of 50 cents per share, you would receive $250, 50 cents by 500, as a dividend payment. Stock dividends. 1. Stock dividends involve distributing additional shares of the company's stock to existing shareholders. 1. While it doesn't provide immediate cash, it increases the number of shares you hold. 2. Example, you own 100 shares of ABC Incorporated. They declare a stock dividend of 5%. 2. This means you'll receive an additional 5 shares, 5% of 100, as a dividend, increasing your total ownership to 105 shares. Special dividends. 1. Special dividends are one-time payments that companies issue in addition to regular dividends. 1. They are often the result of exceptional profits, asset sales, or other specific events. 2. Example, Tech Innovators Limited announces a special dividend of $2 per share due to a successful product launch. 2. If you own 200 shares, you would receive a special dividend of $400, $2 by 200. Dividend reinvestment plans, DRIPs. 1. DRIPs allow shareholders to automatically reinvest their dividend payments to purchase additional shares of the company's stock, often at a discounted price. 2. Example, if you're enrolled in a DRIP for Growth Industries Incorporated, the $50 cash dividend you receive is used to buy more shares of the company's stock instead of being paid out in cash. Preferred dividends. 1. Preferred dividends are paid to preferred stockholders before common stockholders. 1. These dividends are typically fixed and must be paid before any dividends are distributed to common stockholders. 2. Example, Income Enterprises issues preferred stock with a fixed dividend of 5%. 2. If you hold preferred shares worth $1,000, you'll receive $50 annually in dividends before common shareholders receive anything. Dividend yield. Now, let's talk about dividend yield. It's a percentage that shows how much you're earning from dividends compared to the stock's price. Dividend yield is a crucial metric for investors interested in income from their investments, particularly stocks. It helps you understand how much income you can expect to receive relative to the price you pay for a stock. Let's break it down with an example. Dividend yield formula. Dividend yield, percent, equals annual dividend per share, stock price, x 100. Example, suppose you're considering investing in Global Utilities Incorporated. The stock is currently trading at $50 per share, and the company pays an annual dividend of $2 per share. Dividend yield equals $2, $50, x 100 equals 4%. In this example, the dividend yield for Global Utilities Incorporated is 4%. This means that for every dollar you invest in the stock, you can expect a return of 4 cents in dividends each year. Now, let's consider another scenario. Example, you're eyeing Tech Innovators Limited, which has a stock price of $100 per share and an annual dividend of $1.50 per share. Dividend yield equals $1.50, $100, x 100 equals 1.5%. In this case, the dividend yield for Tech Innovators Limited is 1.5%. This indicates that for every dollar you invest in this stock, you can expect a return of 1.5 cents in dividends each year. Interpreting dividend yield. 1. A higher dividend yield indicates a potentially more attractive income-generating investment. 1. However, be cautious of exceptionally high yields, as they might be a result of a declining stock price due to underlying issues with the company. 2. A lower dividend yield might suggest a company that focuses on growth and reinvestment rather than distributing a significant portion of its earnings as dividends. Considerations. 1. Dividend yield is a snapshot of the current situation and might change if the stock price or dividend payments change. 2. It's important to compare the dividend yield of different stocks within the same industry or sector for meaningful insights. 3. While dividend yield is important, it's just one factor to consider when evaluating an investment opportunity. 3. Assess the company's financial health, growth potential, and dividend history. Remember, dividend yield can be a useful tool for income-focused investors, helping them make informed decisions about which stocks align with their financial goals and risk tolerance. Dividend payout ratio. The dividend payout ratio is a fancy term, but it's easy to understand. It's the proportion of a company's earnings that they pay out as dividends. So, if a company earns $1 per share and pays 20 cents as dividends, the payout ratio is 20%. It's like sharing your allowance with your friends. The dividend payout ratio is a key financial metric that tells you what portion of a company's earnings is being paid out as dividends to shareholders. It helps investors understand whether a company is using its earnings to reward shareholders with dividends or retaining more of the earnings for other purposes, such as reinvestment in the business. Let's break it down with an example. Dividend payout ratio formula. Dividend payout ratio equals dividends per share, earnings per share, x 100. Example, consider Steady Growth Incorporated, a fictional company. In a given year, Steady Growth Incorporated reports earnings of $2.50 per share and pays out 75 cents per share in dividends. Dividend payout ratio equals 75 cents, $2.50, x 100 equals 30%. In this example, Steady Growth Incorporated has a dividend payout ratio of 30%. This means that the company is distributing 30% of its earnings as dividends to shareholders, while retaining the remaining 70% for other uses like business expansion, research, and development. Interpreting the dividend payout ratio. 1. A low dividend payout ratio, below 40 to 50%, might suggest that the company is reinvesting a larger portion of its earnings to fuel growth. 1. This could be common among young or high-growth companies. 2. A high dividend payout ratio, above 50 to 60%, indicates that the company is returning a significant portion of its earnings to shareholders as dividends. 2. This might be more typical of mature companies with stable cash flows. Considerations. 1. A very high dividend payout ratio could raise concerns about the company's ability to fund future growth and handle unexpected financial challenges. 2. A very low dividend payout ratio might suggest the company is not utilizing its profits effectively to reward shareholders. Industry and company comparisons. 1. It's important to compare the dividend payout ratio of a company with others in the same industry or sector. 1. Different industries have varying norms for payout ratios. 2. A company's historical payout ratio trends and its dividend policy should also be considered. Investor implications. 1. For income-focused investors, a higher dividend payout ratio might indicate a company that prioritizes regular dividend payments. 2. For growth-oriented investors, a lower payout ratio could suggest a company that reinvests more in its operations. Remember, the dividend payout ratio is just one piece of the puzzle when evaluating a potential investment. It offers insights into a company's approach to dividends and financial management. Consider it alongside other financial metrics and qualitative factors to make well-informed investment decision. Benefits from dividends. Dividends can be a wonderful way to earn from your investments, providing you with a steady income stream. However, it's important to note that not all companies pay dividends, and dividend payments can change. It's like having a cherry on top, but sometimes the cherry might be smaller or missing. Conclusion. So there you have it, fellow investors. Dividends are a fantastic way to enjoy the fruits of your investment labor. They offer a little extra return on your investment, making your financial journey even sweeter. Remember, while dividends are a nice treat, they're just one slice of the investment pie. As always, do your research, diversify your portfolio, and enjoy the journey of building wealth. Happy investing! Disclaimer: this video is for educational purposes only and should not be considered as financial advice. Please consult with a professional financial advisor before making any investment decisions. Thank you everyone for watching our video. Hope you have gained some knowledge from our video. Please share with your friends and family members for more content like this. Thanks for watching.